So we wrote an interest-only loan mod 3 years ago on a very large balance loan where amortized it would be like $3 grand a month, but because of their finances, they could only afford like $1,000 at the time. And instead of really grinding on it to try to get them up to almost triple of what they could afford, which would have involved getting their financials, kind of going through with a fine-tooth comb, looking for areas where they could do a little bit better, you know, they could save some money here to pay their loan. We decided to put a step rate interest-only loan mod in place. So year one, they paid $1,000 a month at a 5%. Year two went up to 5, year 3 to 6, and then the balloon was due April 1st. So the borrower couldn't afford it, but they are working on a refi. They needed an extension till June. And so we wrote a new 3-month loan mod for 7% now, which is $1,900 a month. And they'll just pay interest-only payments for a couple more months and then pay it off in full in like early July. So that deal works out. If you're not going to sell a reperforming loan, if you're okay holding it for at least those 3 years, an interest-only step rate mod I think is a great tool to use because it brings the account current. It encourages the borrower to refinance as soon as possible because the interest rate increases every year, and we never write any prepayment penalties into our mods, so they're incentivized to pay it off as soon as possible. That loan's worth less as a reperforming loan at $1,000 a month than it would have been worth as a non-performing loan. So the only reason you do that is if you're okay holding on to it because eventually you'll get that full payoff. The loan balance $326,000. So huge balance loan, but as a non-performer back 2-3 years ago, it would have maybe been worth 150 grand, you know, a little less than 50 cents on the dollar. Once we got it performing at $1,000 a month, if you spend 150 grand to make $1,000 a month, 12 grand a year on 150, that's an 8% cash on cash return. So we lost value on it by writing that mod, but it increases every year to the point where now for the next couple of months, it's 1,900 and then it'll pay off in June. But definitely keep that in your mind. If you do have a borrower who feel they're responsible, you feel like, you know, they just need a little bit of help getting things back on track for a short time period, you can write that for just a year. You could write it for 3 years. I wouldn't really go beyond 3, but then the refi at the end of it makes it all, your internal rate of return is going to be a lot stronger if you get that full payoff at the end. And we accept interest payments for 3 years. So that's just the cherry on top here. And then we got some other smaller loan mods we're working on, but that was the most interesting since partly because this was a responsible borrower. They proactively reached out because of this April deadline. So they reached out to discuss a refi and an extension to get the refi done in the summer. If you did this with a borrower who was a little bit more flaky, a little bit more difficult, then an interest-only loan mod would kind of shoot yourself in the foot. As we're discussing here, the loan is worth less as a reperforming loan when the monthly payment is so small. And when you get a loan mod in place, it brings the account contractually current. So then if they default, you're letting them buy additional time if you do end up wanting to foreclose. So you really only want to do those when you got borrowers who you trust and they're responsible and just need to get back on track to get underwritten for a refinance. And originally we thought this would refinance in the first year in 2022. And I would look back at the email string and he was like, we're working with the bank. We're going to get a refinance in a couple of months. And now 3 years later, hopefully he's not all talk about this June payoff. But in any case, he made all his monthly payments. So we're good with that.